In the US, many purchases are made using credit. Credit allows you to buy something now and pay it off later. A credit card looks exactly like a debit card, but they are very different. A debit card is linked directly to money that is already in your bank account. When you use your debit card, the money goes straight from your account to the store. A credit card just keeps track of all your purchases and then you pay them back at the end of the month. When you use your credit card, the company sends money to the store and you promise to pay the credit card company back. If you pay the money back in full, you can usually use your card for free. If you spend more money than you have and cannot pay your credit card bill, the company charges you an additional fee because you owe them money. That fee is based on the interest rate of your particular card. The longer you go without repaying the company, the more debt you will have. To get a credit card, you have to apply. A credit card company will accept or reject your application after looking at your credit score. Everyone has a credit score that is based on several factors, including whether they pay their bills, how long they have been using credit, and their track record of paying off loans on time. If you have a lot of debt and cannot pay off your loans, you'll probably have a low credit score. Try to avoid making purchases that you cannot afford because this will negatively affect your credit score. When you receive a credit card, you'll have what is called a credit limit. This is the maximum amount of money you can spend before paying it off every month. At the end of the month, you'll receive a bill from the credit card company telling you how much money you spent and the minimum balance that is due. If you pay off the full amount, you will typically not be charged any fees for using the card. If you pay the minimum balance, whatever is left over becomes debt, and the credit card company begins to charge you interest every month that you do not pay them back. When you're choosing a credit card to apply for, there are many things to consider. You'll hear a lot about a card's APR, which stands for annual percentage rate. This is the amount of interest that the company will charge you every year for the money you owe them. The lower this number, the less money you'll have to pay if you plan on making a large purchase and paying it off over time. You should also consider what the minimum payment amount is for the card and whether or not it has an annual fee. Some high-end cards require you to pay a fee every year in order to use them. Try to avoid signing up for some of these cards as there are plenty of free options. Most big purchases in the US, including houses and cars, are made with loans. A mortgage is a long-term loan that allows you to buy a house, and an auto loan allows you to buy a car. Your ability to be approved for a mortgage or an auto loan is based on your credit history and score. You can build a good credit score by always paying your bills on time, paying off your credit card, and only taking out loans that you know you can afford to repay.